Welcome to the Deep Dive. We're here to break down complex earnings calls and filings, giving you the insights you need fast.
Today we're digging into Parks America, that's ticker PRKA, specifically their Q3 fiscal 25 call from August 11th after the market closed.
And it's a really interesting one because, right after the call, the stock didn't really do much. Traded kind of flat.
Yeah, it was a bit of a head scratcher initially, but then over the next few sessions, boom, it takes off. Ends up gaining what, over 16%?
Exactly. So our job today is to figure out why. What was hiding in that call that made investors suddenly sit up and take notice?
And the quick version, the punchline, is that this wasn't really a revenue growth story. It was all about unlocking this massive profit potential hiding inside the company.
Okay, let's get right into those numbers then. So consolidated revenue came in at $3.476 million.
Right, which as you said was basically flat compared to last year, up just 0.8%.
So looking at that, you'd think, okay, steady state, nothing dramatic.
But that's where you have to look further down the income statement. The real action was in profitability, income before income taxes. It just exploded.
Exploded how?
Well, it hit $1.085 million for the quarter. Now, compare that to the same quarter last year.
Okay.
Last year, it was only $87,000. $87,000.
Wow, okay, wait. So revenue barely budges, but pre-tax profit goes up by more than tenfold.
Exactly. That's the leverage we're talking about. It tells you that the core business, the parks themselves, are actually pretty profitable once you strip away some of the noise at the corporate level.
And that noise, that corporate friction, was a big part of the story this quarter, wasn't it? Management talked about cleaning things up.
They did. They highlighted a pretty significant drop in corporate expenses, down about $123,000 compared to last year.
And that wasn't just random cost cutting, right? There was a specific reason.
Yeah, it was mostly because they were lapping costs from the previous year. Remember, they had that whole proxy contest, legal fees, all that non-recurring stuff.
Ah, right. So those one-time hits went away, and suddenly the underlying profit pops through.
Precisely. You clean up the corporate overhead, and the efficiency of the actual parks becomes much clearer.
And what's interesting is they achieve this while keeping spending pretty tight, capital-wise.
Yeah, very disciplined there. Quarterly capital expenditures, spending on improvements and new stuff was only $95,000 for the whole company.
$95,000. That seems really low for multiple parks.
It is modest. And their D&A, depreciation, and amortization was also flat at around $231,000. This isn't accidental.
So what's the strategy behind that low CapEx?
It ties into their whole model. For a company like this, operating regional parks, the key isn't always building the next giant roller coaster. It's about getting more revenue out of the assets they already have.
Improving asset turns, basically.
Exactly. Driving sales growth faster than asset growth. That's how you get good returns in this space without spending a fortune every year. They want more bang for their buck from existing infrastructure.
Okay, so that's the big picture financially. Profit surge, cost cleanup, disciplined spending. But you mentioned the parks themselves. The consolidated revenue being flat hid some pretty big differences between the parks.
Oh, absolutely. It was not a uniform quarter across the board. Very uneven performance regionally. Kind of a tale of three different parks.
Let's break that down. Where was the strength?
The star was definitely Texas. Aggieland. Revenue there jumped, wait for it, 43%.
43%. Wow. Okay, that's huge. To $820,000.
Yeah, real momentum. That looks like pure demand driving things.
And the weakness?
That came from Georgia, which is actually their biggest park by revenue. Revenue there was down 9% to $2 million even.
Down 9% in the largest segment. That sounds concerning.
It could be on the surface. And then Missouri was sort of the middle ground. Revenue there was down just slightly, about 2.8%, landing at $656,000.
Okay, back to Georgia. Revenue down 9%. How did management explain that, and why didn't investors freak out about their biggest park shrinking?
This was maybe one of the most important points on the call. Management really shifted the focus. They said, don't just look at attendance figures in isolation. Look at per capita spend.
Meaning how much each person who does come spends.
Exactly. So in Georgia, yes, revenue was down 9%. But get this, attendance was down even more. It was down 16%. Wait, so fewer people came, but the revenue didn't drop as much?
Precisely. The people who did visit spent significantly more, on average. That tells you the park operations team there is doing a great job maximizing the value from each guest.
Okay, that makes sense. So even with fewer visitors, they managed to increase the average spend on tickets, food, merchandise. maybe those animal encounters, the whole spending box, as they called it.
Right. It shows operational strength, even when maybe external factors like weather or local conditions kept some people away. Quality over just quantity.
And that contrasts really sharply with Texas, doesn't it?
Completely different story. In Texas, agri-land revenue was up 46%. Sorry, 43%, and attendance was up 44%. So they almost moved in lockstep. Revenue up 43, attendance up 44.
Yeah, roughly. Which suggests that the growth in Texas wasn't primarily about jacking up prices. It was about genuinely more people wanting to come. Real foot traffic, real demand growth. That's the sweet spot.
Got it. Strong demand and likely good per capita spending, too.
Okay, also on the financial front, they finalized that stock split thing, right? The reverse forward split.
They did. They gave the final numbers for that April 2025 action. It was a 1-for-500 reverse split, followed immediately by a 500-for-1 forward split.
Which sounds complicated, but the goal is usually just to clean up the shareholder list, right? Get rid of very small holdings.
Yeah, exactly. It often reduces the total number of shareholders on paper, can sometimes help with exchange requirements, things like that. It's a plumbing kind of move.
What did it cost them, and what was the impact on the shares?
The cost was about $141,000, and the effect was that it reduced the total number of outstanding shares by 3,663 shares.
So if you look at the cost, 141K divided by the shares reduced, 3,663, it effectively acted like a tiny share buyback.
At what price, though?
At an implied price of about $38.40 per share, which is, quite high compared to where the stock often trades. But it shows they're thinking about share structure even in these small ways.
Interesting. Okay, shifting gears a bit to strategy. Management seemed almost surprised by how well the parks were actually being run at the ground level.
Yeah, that was a notable comment. They basically said the general managers running the individual parks are much stronger and more efficient than the newer corporate leadership might have initially realized.
And the proof is Georgia, right? Keeping revenue relatively stable despite a big drop in attendance takes skill.
Exactly. It shows resilience and good decentralized management at the park level. They know how to make the most of the traffic they get.
But if park operations are a strength, they also pointed to a pretty big historical weakness, something they're trying to fix now.
Yes. And this is maybe the biggest potential catalyst going forward, marketing.
Marketing.
Believe it or not, management said the company has essentially never had a dedicated primary marketing person or team.
Never. For a business that relies on getting people in the door, that's surprising.
It is. A regional attractions business lives and dies by local awareness, promotions, getting people excited to visit, and they just didn't have anyone formally driving that from the center.
So what are they doing about it now? Finally hiring someone.
They're building a small internal team. Just 2 or 3 people focused specifically on promotions, social media, local events, anything to drive footfall, as they put it.
Okay, so that's a new cost coming onto the book soon?
It is. It hasn't really hit the P&L yet. But think about the potential upside. If the parks are already run pretty efficiently by strong GMs,
then adding even a small, focused marketing effort could have a big impact. Leverage.
That seems to be the bet. Leverage the existing operational efficiency with some smarter demand generation.
And this ties back to that asset turn idea, right? The Texas example, 43% revenue growth with minimal capital spending that kind of proved the model could work.
Absolutely. That Texas result was the confirmation. You can get significant revenue growth without pouring tons of money into new concrete and steel if you manage demand and operations well. That's what got the market excited post-call proof of concept.
So looking ahead, even though they didn't give formal guidance numbers for next quarter or anything.
No, which is pretty normal for a company this size. They tend not to give specific revenue or EPS targets.
So the catalysts are more
operation.
Yeah, exactly. Investors will be watching. Can Texas keep that momentum going and maintain those strong margins? Can Georgia stabilize its traffic, leveraging that high per capita spend? And are there any hints about M&A maybe buying other similar regional parks? And there was one other potential catalyst, more on the soft side, community stuff.
Right. Management mentioned wanting to build more partnerships with local universities, things like zoology or conservation programs. They specifically mentioned Texas A&M, which is near the Aggieland Park.
How does that help the bottom line?
It's indirect, but it builds community ties, enhances the park's reputation, maybe provides some operational expertise or even intern labor. It makes the park more relevant locally, which long-term should help drive interest and visits.
Okay, makes sense. Let's transition then. Time for our This Is Not Financial Advices segment. We take the call insights, mix in a bit of market reality, and pitch a trade idea. Yeah, always with the big caveat. Purely informational, do your own homework, definitely not advice.
Got it. So what's the thinking here for PRKA based on this call?
Okay, the core idea is that the stock rallied after the call because the market finally recognized the cleanup. The proxy costs were gone, and the underlying profitability, especially the leverage show in Texas, became clear.
So the market re-rated the stock based on cleaner earnings.
Essentially, yes. But the risks are still there. Georgia's traffic is still soft. The whole business is seasonal, weather dependent. It's not a smooth ride.
So what's the trade pitch then? Still bullish. The pitch is basically a long position, but maybe not for the reasons you'd usually buy a stock. It's not necessarily a bet on massive, sustained revenue growth across the board.
Okay, so what is it a bet on?
It's a bet on valuation, specifically applying a reasonable valuation multiple to this new, cleaner level of pre-tax income they just demonstrated. Think of it as an operational hygiene play.
You're betting the market hasn't fully priced in just how profitable the company is now that the one-off junk is gone. Betting on the power of the red pen, cleaning up the P&L.
Something like that.
Yeah.
You're betting that the improved margin profile justifies a higher stock price, even if revenue growth is lumpy. But, and this is a big but.
Liquidity.
Yeah, it's an OTC stock, often trades very thinly, so this isn't a quick flip. It requires patience, conviction, and understanding the specific thesis. You're betting on their ability to run efficiently and maybe find smart, high ROI ways to grow like they did in Texas, not on some huge national expansion.
Right. Focus on scaling smartly with those high asset turns. Okay, let's recap this deep dive quickly. Two main takeaways jumped out for me.
Go for it.
First, that huge profit surge wasn't magic. It was mostly cleaning up those old corporate costs. Revealed strong underlying park profitability.
Check. And second,
the Texas park performance showed the potential massive revenue growth is possible without massive spending. And the per capita spend metric, even in Georgia, showed operational grit.
Couldn't agree more. The cleanup revealed the baseline, Texas revealed the upside potential.
Which leads us to our final provocative thought for you, the listener.
Okay, lay it on us. Management basically confessed we've never really done marketing before. They're just now building a tiny team to focus on it.
Right. So the question is, if they squeezed out that much profit improvement just by cleaning up corporate costs and saw 40% plus growth in Texas, seemingly just through good operations, how much untapped demand, how much more leverage could be sitting there across all the parks waiting to be unlocked by even a small, smart marketing push?
That's the multi-million-dollar question, isn't it? Could marketing provide the next big jump in profitability, similar to how cutting those non-recurring costs did this quarter?
Something to chew on. And remember, that trade idea, definitely not financial advice, purely for discussion. Thanks for joining us on The Deep Dive.